Hello, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Today, we're going to be talking about how to disclose loans without tolerance cures. So, great topic here. Nobody likes losing money. So, this is a good topic here for today. Give us just a moment to go live on all the different platforms. See some comments coming in already. Appreciate it. Hope everybody's been having a great week so far. And it looks like we're live on all the platforms. We'll go ahead and get started. What we'll do is we'll take the chat off the screen for now, but go ahead and drop any comments you have or any questions you have in the chat as well, and Jose can answer them after he goes through the presentation here today. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our CSO, Jose Gonzalez. We are a lender that specializes in non-QM loans, and what we do every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern is our loan officer training, where we do a different loan officer training topic. And today's topic is very important on how to disclose a loan without getting tolerance cures. None of us like those, right? So I'm going to go ahead and turn it over to Jose so he can go through the presentation here.
All right. So, like we mentioned, very important topic. Want to make sure we're accurate. And also, of utmost importance, we want to look out for our borrower's best interest and make sure that we build credibility along the way. Don't want to under disclose and then all of a sudden hit them with sticker shock at the end. So let's get right into it. So what exactly, what exactly do we mean by a tolerance cure? Tolerance cure is a reimbursement made to a borrower when the actual settlement charges exceed the charges disclosed on the loan estimate by more than the permitted tolerances. The lender may cure the tolerance violation by reimbursing the borrower the amount by which the tolerance was exceeded, either at settlement or within 30 calendar days after settlement. Now, there are three different categories to consider. The first is zero tolerance items. You would be looking at Section A, origination charges, right, our lender fees. Section B, which are services that the borrower cannot shop for if a provider list was not provided. If on Section B a provider list was provided, then that would be in the 10% tolerance category. And Section E, taxes and other government fees. Specifically, the one in this section that we're talking about is the transfer tax, which is based on a percentage. So on the 10% tolerance category, these are items that can increase collectively by 10% as a whole. All the items in that category, adding up any of the differences, if it's 10% or under collectively, no need, you're not going to have a tolerance cure when you redisclose the amount. These would be Section B charges, which are the services you cannot shop for if a provider list was provided to the borrower. Excuse me. And the Section E government section, the fixed items only, such as recording fee, assignment recording fees, and stamp fees, if not based on a percentage amount. Any stamp fees based on a percentage amount go into the zero tolerance section. And then we have the no tolerance fee items, no tolerance cure items, which would be Section C, services you can shop for, like, for example, if the borrower switched title companies, or now they shopped for that title company, and we have some different fees that would not be subject to tolerance cure. The prepaids in Section F, like the insurance for the year, taxes, and any other prepaid items. And the Section G, initial escrow payment also. The reserves, like we like to call it, like they're called, and the Section H, which, for example, are the other items like association, capital contribution, things like that. So what would be the best practices for disclosing loans? Well, whenever possible, it is always best to disclose with service providers like Lodestar or Smart Fees for your title company fees, for example, and then redisclose with the borrower selected title company fees once the title order is complete. Avoid, whenever possible, using affiliate title companies or affiliate partners, which may result in zero tolerances, because then you are not giving the borrower the choice to shop that item. So that would be a zero tolerance cure item. So best practices, again, you would want to have accurate cost estimates, again, by either using Lodestar, Smart Fees, pre-CD from borrower selected title company, and then also make sure that you're actually quoting the correct amount for loan origination, correct amount for appraisal. All of the services have to be correct. You cannot just be making the fees up. You want to have a detailed breakdown of the costs, right? Don't just lump them all together. Section A, origination fees, do not underestimate. Your Section B and C, title fees, again, based on your accurate cost estimates. And the Section E, tax and government fees, again, you don't want to just be making up transfer taxes or recording fees. You want to base them on actual numbers. And if you do have any valid change of circumstances, please make sure that you redisclose those valid change of circumstances within 3 days, because any valid change not redisclosed within 3 days will result in a tolerance cure. So last but not least, this is the most important part when we consider if you are going to have a tolerance cure or not. What are the valid change circumstances that can be redisclosed within 3 days without a tolerance cure? Well, the first section would be change circumstance affecting settlement charges. For example, you estimated the appraisal fee was going to be $500. But now, due to the complexity of the appraisal or appraiser availability, they just can't find someone to pick up the order for $500, but the cost would be $800. You have to redisclose that new higher fee to the borrower within 3 days of your awareness of the higher fee. It's not really when the customer pays it. It's like when you became aware that that additional fee was going to be needed. That's when you have to redisclose that additional fee. The next section would be changed circumstances affecting eligibility or value of the property securing the loan. So, for example, borrower credit score drops, resulting in higher loan fees. Or property appraised value is lower than the estimated value. As you know, that could affect the loan to value. As the loan to value increases, it could be a probability that the cost on the loan will also increase. So those would be changed circumstances that need to be redisclosed, again, within 3 days. If you don't redisclose it within 3 days, you're going to have a non-compliant file. Third category, consumer requested revisions. So borrower tells you to increase the loan amount, transfer taxes increase. Well, redisclose the higher transfer tax because the borrower requested to increase the loan amount. If you do not redisclose the new higher transfer taxes within 3 days, now you have a tolerance cure for the increase in transfer taxes. Next category would be an interest rate lock or lock extension, for example, either locking it initially or when you extend the lock, which is going to obviously incur a fee. So any changes to the points, lender credits, and any other interest rate dependent fees would need to be redisclosed within 3 days. Loan estimate expiration. This is an interesting one. You send out the loan estimate, there is an intent to proceed notice in that loan estimate. If the loan estimate is not signed within 10 days, which means basically the intent to proceed is not going to be signed either within 10 days, then a revised loan estimate can be issued that discloses any fees that may have increased during that time period that the borrower did not sign, right? It could be the cost on the rate or anything else associated with it. And last but not least, this is one many people are not aware of: construction loan settlement delay. if closing occurs more than 60 days after the original loan estimate was disclosed, right? That's one we don't use too often, but it can occur because we know construction loans tend to take months to close, sometimes depending on the getting information from the contractor, bids, a number of things that could delay the construction loan from closing. So you can redisclose a new LE with the higher cost. But the main thing to consider there is that if this strategy is going to be used to redisclose the LE, conspicuous notice, this is how it states in the law, conspicuous notice needs to have been given at the original time when the file was disclosed, letting the borrower know that if the closing is delayed by more than 60 days, that the fees could go up. If you don't give them that type of notice in the original disclosure, then you cannot increase any of the fees just because there was a delay. Items and sections, because this is what normally causes a tolerance cure, either that or initially when the loan is disclosed, it is disclosed with underestimated fees. So make sure you follow all of these notices to avoid any TRID tolerance cures.
All right. Thank you, Jose. Let's see here. Looks like we do have a couple questions on this one. First question is there a list anywhere of states which have and don't have transfer taxes?
I am sure there is. Just go to the online search engines and look for, that's a really easy one to find out. You can just search each state for transfer tax and you should be able to get that information very easily.
All right. Do we have another question here? I know standard practice is charging 275 basis points to the customer, but NC caps mortgage loan origination fees at 0.25%. How do we square those seemingly opposing numbers?
Well, when it's
okay.
Yeah, I mean, first of all, if we're lender paid, it's included in the rate. You're going to run your points and fees test. You have to just include what they're talking about. Loan origination is like underwriting fees and stuff like that. So you go fees in when the file is being disclosed, so you don't have any of those extra fees. And then hopefully when you run your your points and fees test, you're going to get some bona fide discount points. So that's going to help you pass any of those state tests for states like North Carolina. And also to note, I believe there's a limit on that. It's only applicable, I believe, for loans under $300,000.
All right. Okay, I don't see any other questions, so we'll go ahead and wrap it up. Great training here, though, today. Very important. Remember that we do this every Tuesday, Wednesday, and Thursday at 12 p.m. Eastern, where we go through a new loan officer training topic. So we will see you all tomorrow at 12 p.m.